So T-bills has been one of the safest, if not the safest investments that any Singaporean can start using to earn some additional income, which can then be put towards something else to grow our money. And since T-bill is super safe, there's a ladder strategy that we can use to stack out T-bills and build it in a way that we can constantly get income every single month and repeat this cycle to literally print money. So if you don't know, T-bill is a treasury bills from the Singapore government that allows us Singaporeans to earn a sweet 3% and upwards of interest depending on markets. And to some, this 3% might not be very attractive because there are fixed deposits that are boasting similar rates, like ICBC giving you a 3.55% for a 3-month tenure. Maybank can give you up to 3.9%, or even banks like Citibank giving you up to 4% if you're able to deposit $250,000 with them. That's a lot of money.
Got my mind on my money on my mind.
But looking back for the past 6 months, the 6 months T-bill, the ones that we generally purchase, has been ranging between 3.7 to 4.3%. And currently is almost at its lowest point. So when the interest rates of T-bills are at the lowest point, this means that we get less interest. And if the interest is increasing, then the interest rates are much better for us. So ideally, we will want to have as much interest as possible, but as we know, timing the market isn't something that everyone can do accurately, and this is why we have the ladder strategy. So if you have invested in stocks or looking to start investing, chances are you have come across the term dollar cost averaging or DCA. So the ladder strategy is something very similar but a little bit different for good purposes.
Same, but different.
So the main purpose or the main objective of T-bill ladder strategy is to spread our money across multiple T-bills, which will then allow us to collect interest every single month and afterwards get the interest back, and we can start rolling this money back into the market. So to get started with this, you will definitely need some money, and we'll go through how much you need in total to get started and what's the potential return that we can get with this particular strategy. So we know that T-bills have a minimum of $1,000 with a $2 admin fee, which means that we will need $1,002 to get started with this strategy. So what we are going to do is to aim to buy 6 months of T-bills, which will then allow us to get interest every single month. And if you're confused with this part, let me explain. So in a regular stock or bond situation, the interest or dividend or coupon is usually paid in a specific date or after a 10-year period. So for example, the Singapore Savings Bond, if you do an investment, you'll receive it at the end of 6 months and every 6 months after. The same goes for stocks or ETFs. So unlike SSB or stocks, T-bills will pay the interest upfront. So let's say if you're looking to invest in a 6 months T-bill, the interest rate is 3% with a minimum investment of $1,000. What will happen is on the day of issuance, your bank account will get deducted $1,000 minus $15, which is $985 instead of $1,000. So this number is derived from the 3% interest rate of $1,000, which is $30. So this $30 is an annual interest rate, but since T-bills is only for 6 months, we'll only get $15 of interest. So right now, our upfront investment is $985 with $15 as a profit. But at the end of 6 months, you'll be credited back $1,000. So the profit in this sense is paid upfront. So you are free to do whatever you want with that profit, be it reinvest into other instruments or just hold it in a high-yield savings account. So to get started with this strategy, you need at least $6,012 because we're going to invest into T-bills every single month for 6 months. And then we rinse and repeat if the interest rate stays good. So hypothetically, if we started investing in November 2022 and did the ladder all the way to April 2023, investing into T-bills every single month, we have earned a total of $121 before fees, and after fees over the 6 months is roughly $109 just from the interest alone, and we'll have $6,000 that is pending to be released every single month from May 2023 all the way to October 2023. So based on calculation, the first release of capital will be in May 2023, which means that we'll have $1,000 going back into our bank account, and these $1,000 can then be reinvested into the May 2023 T-bills. So this cycle can keep on going as long as the interest rates are attractive or above what you can get from fixed deposits in the local banks. So to some, $100 might not be a lot, but this is based on us doing a minimum investment of $1,000 per month into T-bills, and definitely if we scale this up, the number is going to increase as well. So if we did $5,000 of investment per month into T-bills, we'll be looking at something roughly around $600 for the next 6 months, or roughly $100 a month, which then you can decide what you want to do with the money. And with the current interest rate hikes, we can expect the interest rate to increase a little more, and some of us might just want to take advantage of this small opportunity. But with all that said and done, there is also pros and cons to this strategy. So one of the biggest cons is the minimum amount required to do this strategy, which is $1,000 a month. So this could be a pretty huge amount for some, and if you go by the rule of thumb, which is to allocate 20% of your income to be used as an investment, and based on that numbers, this means that one will have to earn roughly $4,000 a month to get started with this strategy. And the second con of this is your money will be locked in for the next 6 months. So 6 months is a very weird period because it's not too long and it's not too short as well.
Not too long, not too short.
It's like an in-between. So when you invest in T-bills, your money will only get released after 6 months and you'll not be able to liquidate your money within that time period. So if you're looking to leverage on this strategy, ensure that you have enough float or emergency funds. In the event that you need some liquid cash, you don't have to borrow or take a loan to fund your basic living. And lastly is the opportunity cost. So if you look back at the T-bill interest rates, we can see that the interest rates for T-bills do fluctuate quite a bit compared to other investments like fixed deposits or SSB, where the changes are not as volatile. But with your money locked in for 6 months, this means that if there's a great opportunity in the markets, you might not be able to seize it because your money is still locked in, leading to an opportunity cost. So with the bad stuff aside, there is one big reason why you should leverage on this strategy if you can, and it's because it's a low to no risk investment. So T-bills are backed by the Singapore government and its capital is guaranteed after a 6 months period, which means even if the interest rates are low, you will still retain your capital. As compared to other instruments like stocks or ETF, your capital is basically not guaranteed and there is a chance that you might even lose your capital if the company collapses in the market. So this brings us to the end of today's video. Thank you guys so much for watching. If you haven't, do drop a like, let me know your thoughts about the T-bill ladder strategy. As always, stay safe, invest safe, and I'll see you guys in the next one.